Welcome to Market Matters presented by MyX. I'm Joe Tigay, and with me is Brian Stutland. How you doing, Brian?
Great. Good Monday here.
Happy Monday, happy Daylight Savings Day. Boy, that can be a trip with young kids, but we're getting through it, and it's all for the best. So wanted to talk about this week. We've been talking about it for a while. The short volatility trade. The ETFs are booming, and they're just getting bigger and bigger.
Yeah, it's been quite an interesting flow that we've seen both in ETFs and mutual funds, other separately managed accounts, where we just see investors, frankly, we've gotten yields higher in interest rates, right? And now people are looking for additional yield to their portfolio besides just buying US Treasuries. And where have they looked into some of these ETFs? And I mean, just take a look at their nobody will see this coming, right? Is the billions of dollars that are pouring into these short funds. So we're going to talk about that on the show later in the show. That's going to be the big topic, the big trade idea of the day. And we're going to discuss how this could shake out later in the year if this just keeps getting bigger and bigger on this trade.
Yeah, we were trading our long volatility strategy during Volmageddon, so we had a front row seat to this, and we'll talk about how exactly it relates as we go on. But we'll get into that later. Right now, we're going to talk about the big news of the week. We got CPI coming out tomorrow. This was a market mover in February when the January came out. The expectation in January was 2.9. The market got 3.1. Tomorrow's expectation is 3.1. Brian, what do you think the CPI is going to be tomorrow? Is it going to beat or going to be worse?
Well, I mean, it still feels like the Fed hasn't done enough to control inflation. And obviously, last week we had Paul say that, hey, we're not going to cut rates as fast as people think, at least until the data comes in. But now some of the expectations are getting a little bit more extended. So I wonder if actually we hit a number that appeases the market and the market can continue higher. But we're going to talk about this in the show. That strike of 5,000 on the S&P is still in play.
January was hotter than expected. It seems reasonable to see something come back in line, reversion to the mean. Some of the things that were a little extended in January coming back in February, and we'll see a smooth out. So maybe a better than expected number could be in the cards for tomorrow. Should be interesting to see, of course, that policy statement next week. When that first cut's going to be, they're not likely to cut in March, of course, but when that first cut's going to be and how many cuts we're going to get this year, the CPI is really, really critical to all of that. Last week, we had this fear and greed index. We were in extreme greed. We're coming off of that. We're just in the greed levels. So we'll see. Was Friday some sort of frothy toppy action? Remains to be seen tomorrow. We got a lot of catalysts in the near future.
Yeah, and the greed index ticking up a little bit there just because, we've seen the VIX now tick up, volatility tick up on this little back and forth action. March, the markets are basically unchanged, but the VIX is higher, and we'll get to that. And so that's really adjusted the greed index factor there. So we'll see how that shakes out in the next week.
Yeah, now bringing it back to some more options action, Brian. This is something I wanted to look at here. This is the max pain for this week. Now, this is the options expiration week. The most open interest in the S&P 500, the SPX index, is right at 5,000. So that's where people say the max pain will be when you get this high open interest like we see in the S&P 500. Sometimes stocks have a tendency to drift toward that strike or be a magnet. There's a magnet sucking the stock to that price.
Yeah, and when you look at that, typically what happens is when you have instruments, the underlying instrument where puts out trade calls, meaning you have a higher put to call ratio, what happens is that open interest becomes an attraction that Joe talked about, that magnet. That's what I meant before when I was speaking about 5,000 still being in play in the S&P. After this CPI number, we'll see how attractive that strike is, but that's something we're watching and actually kind of shaping our own positions in our trading strategies to play that in case we get that magnet pulled to 5,000.
Yeah, for me, I do see like this acting like a magnet, but at some point there's some sort of escape velocity. And when it gets to a certain level, it just pushes it away. And it's like it's a oppositely charged magnet. It's very similar in the SPY, lower max pain, right about 3% lower at 491 for the SPY. So just looking at that for For the options, Max Payne. And this is something we've been talking about too, this VIX being in an uptrend since the middle of December. Volatility is on the rise. We know, of course, the market is also on the rise. Last week, we were talking about the AI bubble. If you missed that show, go back and check that out. But this, for me, is what you see in a bubble. You got stocks higher, you have volatility higher. And when I hear the term bubble, I kind of think I hear it and I think, oh, stocks are going to be going higher because we're in the middle of a bubble. And we shouldn't be so afraid of that. But we should remember, in the midst of this bubble, there could be big bouts of volatility. Just take a look at Friday and NVIDIA if you're curious about what that could mean.
Yeah, but I do think it's interesting, this uptrend that we are seeing in the VIX here, that we are near the top end of that uptrend channel. So maybe we do get some relief after this CPI number comes out, where volatility comes in, meaning option prices would decline in value, relatively speaking, across the board. So we're definitely on the top end of the channel. But Joe, you make a great point. Like, look, I mean, we're making higher lows in the VIX. Every time the VIX gets down below 14, it kind of stops at a higher level. To me, that's institutional traders out there going in and wanting to buy puts on the downside anytime there's a little bit of a rally in the market and volatility comes down and option prices become more attractive. Institutional traders are going in and buying those downside puts.
Yeah, and what's the play for options traders when you see this stocks higher, volatility higher? Well, a lot of retail are out there buying calls into these names. So we'll see if that's going to be the big winner for this year. In the middle of a bubble, it makes a lot of sense for me to be looking at. That's how you want to trade the market.
Yeah, this is interesting here, Joe. You bring up here this VIX term structure that we're seeing, because we are seeing this channel higher in the VIX. And if you look back, this recent shakeout, like I mentioned earlier here, the March in the S&P, we're basically flat. We're basically kind of back to the same spot that we were on the end of Feb 29th, leap day. But yet the term structure has increased. Well, why has that happened? If you look at the VIX on the front end of it, it's been trading higher now than the March future, which is going to expire next Wednesday. And so it seems to be pulling up, the options in the S&P are pulling up the value of the entire curve. The rest of the shape of the curve looks pretty normal to me, but it's this angst of level of realized volatility that may be coming down to the pipeline that, let's get back to that point, squeezing out that short option trade that's out there.
Yeah, and of course, just like last week, we have the spot above the front month future. Remember, this future expires week after Wednesday, so it's actually expiring after the regular options expiration. But when I see the spot above the future, that usually is a time when I see more volatility in these futures than normal. So yes, the volatility could fall, and it will fall in quickly because the futures are kind of predicting it to fall. Or if the volatility does rise, there's some catch up to do for these futures. So there's a couple things going on. We have just a week till expiration, and we're at this discount. So there could be some volatility in this front month for the next week.
And I think the angst here and the volatility that could be coming in the front month. Also, we mentioned the FOMC meeting next week. Obviously, that's going to be come basically in line after the March expiration VIX future expires. So now people are saying, okay, let's discount the March VIX future a little bit. Let's price in the back part of the curve. And along with that event, all that's going to tie together. And like Joe, you mentioned, typically you see these big volatile moves in the VIX futures contracts, following those kind of events.
So that gives us a steeper than normal roll here.
Yeah.
Because people are piling in, they're not looking at March, they're looking at April front month as the future to play for that FOMC. So that is interesting. It's very costly to play that role for the next week. So let's bring it to our big story. Of course, Brian, we're talking about this at the start of the show's Volmageddon 2.0. And there's been a lot of discussion about this. We've talked about this already as the potential of as this short option ETFs are just gaining in popularity. Look at the size of here, 60 billion in assets here, just really growing and growing and growing. And this is something that people, kind of missed at the first Volmageddon. These, short VIX future assets just kept on growing and growing and growing and kind of went overlooked until it was too late, kind of. Is this something that we're going to look back on and say, whoa, we should have seen something coming, because this is just out of line?
Yeah, I mean, there's so many ETFs out there. One name I can, come to example is QILD. That's the Nasdaq buy right ETF. Those assets have grown huge. It's obviously selling a option against, basically what is a long position. So it's basically like a buy right kind of strategy. And so what ends up happening is, it maybe in this sense, before we had the Volmageddon, which involved VIX futures, and that's really implied volatility. And the VIX exploded temporarily for a day or two, and that really shook the market up for the rest of the year. In this situation, people are playing realized volatility, not moving so much. We've actually, Joe, been taking the opposite side of that, right? We've been actually trying to buy options, play the realized movement. So this could be an actual realized movement that sort of burst this bubble. And then all of a sudden you look up and the markets have moved 15% one way or the other, and people are caught off sides on this short option play.
Yeah, and there is obviously a major difference we should point out right off the get-go, is that on these short VIX future ETFs, they had a stop loss and they had to liquidate at a certain point. Now, there is no necessarily stop loss or any liquidation level for some of these buy right short option ETFs. But there could be a point, a tipping point for maybe some institutions, some investors that just say, I was expecting low volatility and I'm getting high volatility here, because we know these funds, they earn some extra income to give up some upside, and they don't protect very much to the downside. So if we're getting big downward moves and we're starting to see some outflows in a big way in these funds, that could kind of really trip up volatility and really start it to cascade against itself, because volatility is higher, and now it's a little harder to get out of these funds, and volatility is higher, and it just keeps on going. And that's where you could see, like, maybe not a short flash crash type of a Volmageddon, but kind of like a weeks long, like, wow, volatility is crazy high for these levels.
Yeah, and I think we're already starting to see some benefit in our rational equity armor strategy that we trade. Yes, we do have some short plays on, but it's a long short options trade. Net, we want to own volatility. We want to own realized movement. We've had a lot of success in that trade this year, and it's benefited from a bunch of these little micro bursts of realized volatility movement. We think that continues, and maybe that turns into, instead of a micro, it turns into a big macro event that does get this shakeout and outflow from some of these funds.
Now, do you think it could benefit from owning like the two strategies type together? Like, some of these funds, they are good. They do have a little extra yield. Would it be a benefit to hold them with an equity armor fund?
Yeah, I mean, I think when we talk with clients and potential investors, one thing that I like to mention is that, look, the short option trade, it's been working. I'm not going to say it's bad. It's been a pretty good trade. It adds additional yield for investors, which they're looking for. Investors willing to take a little extra risk, not a ton of extra risk, but a little, collect some income on their portfolios. But I just wouldn't be all in. The same way I would diversify an equity portfolio, I would look to diversify my option trading strategy portfolio. And you yourself, then, that allows people to sort of have a long short. Like if they had a QILD, coupled with our NASDAQ hedged equity, you're short some options in the NASDAQ, but you also have a long volatility position with our strategy. So I think a mix of trying to trade around this area makes a lot of sense.
Yeah, and bottom line is these short option ETFs, their exposure is on the wings. A big upward move in the market, unfortunately, they do not participate. A big downward move in the market, unfortunately, they capture almost all of those losses. So that's some exposure on the wings. I think that's where marrying that strategy with our strategy pairs very, very nicely.
Yeah, for sure.
All right, let's bring it on to the stock of the week. We're going to do an AI stock of the week. This will be a new segment for us. This is something we've been following closely. And if you've been watching our show, this is a stock we picked ahead of earnings. We had a long play on this ahead of earnings, and we're looking at Palantir. Brian, a lot of people are focusing on in NVIDIA. They're seeing these growth in sales, this explosive growth in revenue. And that's just been the story. People are buying these chips. They're buying these servers. They're getting ready for the next wave of the AI revolution. Well, Now that they have these computers, now that they've built their servers out, what's going to be the next step? What's going to happen next? Well, for me, we have to look at some software companies, because you got these servers, you got this data. What do you do with it? And that's where a company like Palantir comes in. Now, this is going to be the second wave of this revolution. How do you manage this data? How do you capitalize on the AI and make smarter business decisions? This for me is Palantir. It's a company. It's up 70% on the year already, but still has not quite had that NVIDIA aha moment. Like, wow, this is the next wave of AI.
Well, Joe, I mean, it hasn't had the aha moment like NVIDIA, but it's getting close. Let's look at the chart on the technicals. You can maybe speak a little bit more about the fundamentals, but I'd like to point this out first. Is we've seen this stock Palantir. It IPO'd. Everybody was very excited about it. You know, cyber security and working with the government contract. And then all of a sudden, all the love kind of like went out. The air kind of left the room, and the stock went down. But since then, we've seen this nice basing pattern. It's a typical technical term we call cup and handle, where you get this, you know, trough, then you go sideways. There's this consolidation, and now the last earnings, we saw huge volume as the stock broke out to the upside. I think that $20 level that it broke above now is going to become a huge amount of support for the stock. And so from a technical basis, it seems like it's trying to start to get into this play, this NVIDIA love of AI here and breaking out. So we really like this stock. Like I said, I don't have a specific option trade today on this, but one thing I'm looking to do basically is some sort of risk reversal where I will sell a downside put where I'm willing to get long. And let's call that around the $20 strike level because of the way the technical side up. And I'll buy an upside call or an at-the-money call. So now I've bought a call, but I've reduced some of the cost by selling a downside put. And this is another way to sort of play the stock to the upside, especially after it's already broken out. Maybe we do get a pullback here to the $24, $23 level, but I'd be a buyer in that level. I'd use some option things called risk reversals to play that and continue that to the upside, because I think Palantir is just getting started on what they can do in the AI world, just more specific towards, you know, security kind of military kind of things.
Yeah. And I mentioned, you know, these AI stocks are going to be very volatile. You know, we're looking at, you know, a high forward PE. If you look at the the current PE, it's around 300. But if you look at the forward PE, because we're projecting pretty significant growth in this company, still, you know, almost at its 80. It's a 57 billion market cap company. So to get this to be like, you know, a 250 billion market company, it's going to need to see a lot of growth, but the potential is there. People are talking about AI. The excitement is there for me. But, you know, I don't want to get into, you know, too much of what exactly they're doing, but just for me, this is the next generation of AI just coming in. How do companies analyze this data? How do they use it? How do they, you know, profit off of the AI? This is the company for me.
Yeah. Well, we're going to cut this show a little bit short. We want you to get back to lunch. It's time to get back at it.
Wait, one more point though. This company just missed making the S&P 500 the last quarter. SMCI just barely beat it out the last second, and that was worth 25% for SMCI. I'm not saying it's going to be worth 25% for Palantir should it be in the S&P 500, but there is a big catalyst to the upside if that does happen in the coming quarters.
Yeah, that definitely could be a little extra boom for it, Joe. Well, that just about wraps up our show here today. Get back to lunch. Get at it for the rest of the week. We've had a great show. Thank you, Tradier Hub show presented by the MIAX here. Tune in next week, every 1 p.m. Eastern on Monday. We'll bring you some more action here. We'll see how the rest of the week shapes up. Watch that CPI number like we talked about, and we'll catch you next week.
Have a good one.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be active actual live trades or positions. Such information is not intended to be financial or investment advice. Trader Inc. is the parent company of Trader Brokerage Inc. Trader Brokerage Inc. and Trader Inc. are separate entities with their own products and services. Securities products and services are offered through Trader Brokerage Inc. Trader Brokerage Inc. is an independent subsidiary of Trader Inc., all rights reserved, member FINRA SIPC.